Welcome to Tech Money Madness Weekend Edition, your bite-sized investor education series. Today's topic, position sizing. How big is too big? Imagine doing the impossible. You comb through thousands of companies, you find the perfect stock, you hit the buy button, and over the next year, it surges 500%.
You're feeling like a genius at that point.
Oh, totally. You are a genius. But then you check your account balance and your overall portfolio barely moved. What? Because, well, you only put $50 into it.
Right. It's frustrating.
Or, imagine the exact opposite. You find this totally solid, reliable company, but it hits a rough patch and dips 20%. Except this time, your entire retirement account is severely wounded and you're suddenly stressed about paying your bills. Today, we are talking about the silent multiplier of investing.
It really is a silent multiplier. And, it's something that genuinely separates amateur investors from the professionals. Because finding a great investment opportunity, like doing all that rigorous research, that is really only half the battle.
Yeah, just half.
Right. If you get the scaling wrong, even a brilliantly researched idea can either cause significant damage to your portfolio or leave you with incredibly frustrating, minuscule gains.
And that is exactly what we are unpacking for you today. We're diving deep into the mechanics of building a portfolio, and we're pulling insights from the CFA Institute, the Securities and Exchange Commission, and Investopedia. We really want to figure out the engine under the hood of true risk management.
It's such an important deep dive.
It is. And as I was reviewing the source material today, it actually really reminded me of cooking. Building a portfolio is a lot like making a complex, heavily seasoned dish, like a curry or a chili.
Oh, I like where this is going.
Right. So picking the right stocks or assets, that is like choosing your ingredients. You obviously want high-quality stuff. But position sizing, that is getting the exact right amount of spice.
That's a perfect analogy. It perfectly captures the dynamic.
Because if you put in, way too much of a powerful spice, you completely ruin the dish. It becomes inedible, and the heat is literally all you can taste.
Yeah, you're just chugging milk at that point.
Exactly. But if you put in too little, because maybe you're terrified of the heat, the dish is entirely forgettable. You don't even know the spice is there, so you wasted a great ingredient.
It's incredibly accurate. And what's fascinating is that a lot of investors, they spend 99% of their time shopping for the ingredients. They read the earnings reports, they look at technical charts.
They listen to the boring conference calls.
Yeah, exactly. They do all the homework to find a company they absolutely love. But then, after all that precise research, they just grab a random, unmeasured handful of that spice and just, throw it in the pot.
They literally just wing it.
They wing the most important part.
Yeah.
And as we're going to see from the institutional perspectives today, scaling that investment, finding that mathematical deliberate spice level is what actually dictates whether you're going to enjoy the meal or end up calling for takeout. The major financial institutions view this as completely foundational. I mean, the CFA Institute explicitly notes that deliberate position sizing directly dictates your overall portfolio performance, far more than the individual asset selection itself.
Okay, but let me stop you right there and maybe play devil's advocate for the listener for a second.
Sure.
Because I think a lot of people sitting at home with a brokerage account might look at this and say, well, why overcomplicate it? If an investor just buys an equal amount of 20 different things they like, isn't that enough?
Ah, the equal weight approach.
Yeah. Let's say I have $20,000 and I just put exactly $1,000 into 20 different companies across, different sectors. I've diversified. Doesn't simple equal weight diversification naturally fix the risk problem without needing some advanced sizing strategy?
It is a very common way of looking at it, and honestly, it feels logically sound on the surface. You're spread out.
Right. If everything is exactly 5% of my portfolio, no single company can destroy me.
But if we look at the frameworks provided by the SEC and the CFA Institute, blind diversification, just chopping your money into 20 equal slices, it is not true risk management.
Really? Why not?
Because not every investment carries the exact same level of inherent risk, or the same underlying volatility, or the same potential for return. Let's look at your equal weight scenario. Imagine you put $1,000 into a highly volatile, highly speculative, emerging biotech startup.
Okay.
And then you put another $1,000 into a very stable, slow-moving national utility company.
Right. So I have my fast grower and my slow, steady dividend payer.
Exactly. But mathematically, your portfolio is now massively skewed toward the biotech asset. The utility company might move, 1 or 2% a month?
Yeah. If that.
Right. But the biotech company might swing 20% in a single day on a clinical trial rumor. Because the biotech stock is so much more volatile, its daily swings are going to completely dominate the movement of your overall portfolio. Yeah, the volatile asset becomes the heartbeat of your entire account, even though they represent the exact same dollar amount on day one.
Ah, I see. So taking a flat, equal weight approach is basically ignoring the unique underlying characteristics of the ingredients you just bought.
Exactly. To bring it back to your cooking analogy, it's like saying a tablespoon of salt and a tablespoon of ghost pepper hot sauce are the exact same thing just because they both fill a tablespoon.
That is a recipe for a hospital visit.
Yes, it is. And that's why winging it with equal portions just isn't enough. You have to move from just throwing equal tablespoons into a pot to actually calculating the optimal allocation based on the heat of the asset.
Right.
The ultimate goal here, the holy grail of position sizing, is balancing potential returns against potential losses. You want to maximize your upside while continuously protecting your capital base.
Okay, so if we know we can't just use equal tablespoons, how do we actually find the right measurement? Because the sources point out that before we can even use a formula to find that number, there are prerequisites. Like we have to do some soul searching and some data gathering first.
That's a crucial point. You can't just plug numbers into a machine blindly. The first prerequisite is that an investor must determine their overall risk tolerance and their specific investment objectives. Like, what is the actual goal of this money?
Right.
And realistically, what level of total portfolio decline can you stomach before you panic and sell everything at the absolute bottom?
Which people do all the time. And I guess the second prerequisite is evaluating the specific risks and returns of the individual opportunity you're looking at. You need to have an expectation of its specific behavior, like what is the upside, what is the downside?
Exactly. And once you have those two pillars established, your own internal risk profile and the external profile of the asset, you can start using mathematical methods to determine the optimal position size.
And the most famous framework highlighted in our sources today is the Kelly criterion.
Oh, the Kelly criterion. It's legendary in quantitative finance.
It is. And I really want to break this down for you, the listener, without turning this into like a high school algebra class. Because if you look at the raw formula on paper, it's a bunch of letters, parentheses, and division signs that look totally intimidating.
It looks like alphabet soup, honestly.
Yeah.
Yeah.
But conceptually, it is actually a beautiful, intuitive mechanism.
It really is. It's essentially just a balancing scale.
Yes, let's explain it like that. The Kelly criterion is a scale. On one side of the scale, you put your edge, which is how likely you are to win. Like, what is the probability that you are right?
Okay, the edge.
Right. And on the other side of the scale, you put the payout, which is the ratio of how much you stand to gain versus how much you stand to lose.
Yeah.
The formula simply takes your edge and your payout, weighs them against each other, and finds the exact tipping point where you maximize your long-term growth without risking the total destruction of your portfolio.
That is such a perfect way to visualize it. And to make it even more concrete, let's walk through the specific scenario provided in the source material, but keeping that balancing scale in mind.
Let's do it. So let's say you've researched an opportunity. Based on historical data, valuations, and your own analysis, you determine there is a 60% chance that you are going to be right and the stock will go up.
Right.
Which means inherently there is a 40% chance you are wrong and it goes down.
So that's the edge side of the scale, a 60-40 advantage.
Right. Now for the payout side, if you are right, you project the stock will gain 20%. But if you are wrong, you project the stock will fall by 15%.
Okay, so we have a 60% chance to make 20% and a 40% chance to lose 15%.
Exactly. Now, instead of guessing how much of your portfolio to risk on this, you run those four numbers through the Kelly criterion scale. And when you do, the math spits out an incredibly precise answer, 0.055.
Or in plain English, 5.5% of your portfolio. That 5.5% is the mathematically optimal fraction. It's the exact amount of ghost pepper for that specific ingredient based on its unique profile.
Which is amazing to have a specific number.
It is. Because if you risk more than 5.5%, the math says you are taking on unnecessary volatility that could drag down your long-term compounding. But if you risk less than 5.5%, you are literally leaving money on the table given your structural advantage.
But wait, let me push back here. Because if the listener is paying close attention to the language we are using, words like odds of winning and probability of losing and payouts, This sounds very much like something a card counter would use at a blackjack table in Vegas.
It does sound like that, yeah.
In fact, I know the Kelly criterion was originally developed for gambling and telecommunications. So my question to you is, isn't applying this to the stock market fundamentally flawed?
No.
Well, in blackjack, there are exactly 52 cards in a deck. You know the exact mathematical odds. But in the stock market, nobody actually knows the true probability of a stock going up. Isn't assigning a 60% chance of winning just guessing with extra steps?
That is the ultimate critique of the Kelly criterion, and it's a fantastic pushback. You are entirely correct that the stock market is not a casino deck of 52 cards. It is an incredibly complex, chaotic system. And our inputs, that 60% probability or that 20% gain, are ultimately just estimates.
So if the inputs are just estimates, why trust the exact output of the formula?
Because of what the formula forces you to do psychologically.
Okay, tell me more.
By forcing you to assign hard numbers to your expectations, it acts as a defensive tool against your own emotions. Furthermore, because professionals know that their stock market estimates are imperfect, they rarely use the full Kelly fraction. They use what's called a fractional Kelly or a half Kelly approach.
Meaning they calculate the 5.5% and then they deliberately only invest half of that amount.
Exactly. They might invest 2.75% instead. They use the Kelly math to establish the absolute mathematical ceiling of what is reasonable, and then they build in a massive margin of safety because they know their 60% probability estimate might be slightly wrong.
That makes a lot of sense.
And what's fascinating here is how bringing this probability framework into investing does the exact opposite of treating the market like a casino.
Wait, really? How so?
Well, when retail investors operate without a framework, they invest based on gut feeling. They think, oh, I love the CEO, the product is amazing, this feels like a sure thing. I'm going to put 40% of my net worth into it.
Oh, yeah, we've all seen that happen.
That is gambling. That is treating the market like a casino because it's driven entirely by the emotional thrill of a story. But the Kelly criterion, even with estimated inputs, forces you to step back and act like an insurance actuary.
Right.
It turns what feels like a gamble into a disciplined, calculated business decision. It forces you to acknowledge that you might be wrong.
That makes a lot of sense. If you honestly believe you have a 100% chance of winning, you're just lying to yourself. The formula physically requires you to enter a probability of losing. It builds the reality of loss directly into your allocation.
Precisely. It prevents your unchecked enthusiasm from picking the position size.
But here's the kicker. Even with elegant mathematical concepts like the Kelly scale existing in the world, human psychology still manages to get in the way and blow up portfolios.
Oh, all the time.
Right. If the math is this clear and a formula can hand us the exact percentage to invest, why do so many smart investors still end up risking too much and facing ruin? The source material highlights several massive psychological traps that cause us to deviate from the math.
And the biggest one, without a doubt, is the overconfidence trap. This is the tendency to allocate way too much capital to a single investment, completely ignoring risk management.
And let's dig into the actual mechanism of why that happens. Because it's easy to just say, well, people get overconfident, but why does a smart person suddenly bet half their portfolio on one stock? Our notes suggest this is heavily driven by behavioral finance mechanisms, specifically something called recency bias.
Yes, recency bias is the culprit here. Look, human brains are pattern-matching machines. If you make an investment and it goes up, your brain releases dopamine. You feel great.
Obviously.
Right. And if you make a second investment and it also goes up, your brain starts to trick you. It tells you, hey, you aren't just getting lucky in a bull market. You have a golden touch. You have figured out the secret to the market.
So you string 2 or 3 wins together and suddenly you think you are Warren Buffett.
Exactly.
Yeah.
And that recency bias, the memory of those immediate past wins, creates a profound overconfidence. So when the fourth opportunity comes along, instead of using your disciplined 5% position sizing, you say, I'm a genius, this one is a lock, and you allocate 35% of your capital to it.
You just abandon the math.
You abandon the math completely. And invariably, that fourth trade is the one that goes against you. And because the position size was so massive, it wipes out all the gains from your previous wins and eats straight into your principal.
It's the classic trap of mistaking a bull market for personal brilliance.
Absolutely.
There is another major trap mentioned by the CFA Institute, which is the day trader myth.
Oh, this is a very pervasive misconception.
Yeah, it's this idea that position sizing is only relevant for fast-moving traders. People think, oh, mathematical formulas and risk management, that's just for guys staring at 6 monitors in a basement making 50 trades a day. I'm a long-term investor, so I don't need to worry about sizing.
And the CFA Institute explicitly calls this out as a dangerous myth. Position sizing is just as essential for long-term investment management.
Really?
Yes. The math of risk, return, and volatility applies to your capital, regardless of whether you plan to hold the asset for a day, a year, or a decade.
Which flows perfectly into the third big trap, the set and forget myth. Investors mistakenly believe that position sizing is a one-time event. You set the perfect size on the day you buy the stock, you put it in a drawer, and you never have to think about it again.
And this crap absolutely destroys long-term buy and hold investors.
Let's explore that because I know a lot of listeners fall into the buy and hold camp. If someone is buying a stock to hold for 20 years, how does overconcentration secretly sabotage their long-term goals? I hear people say, I have 20 years to recover from any dip, so if I put 40% of my portfolio into this one amazing company, time will bail me out.
Let's use a historical analogy to show why time doesn't magically erase concentration risk.
Okay.
Let's look back to previous eras of the market. Imagine a dominant, unquestioned blue-chip company, maybe a massive telecommunications monopoly or a seemingly invincible energy conglomerate from a few decades ago.
Yeah.
At the time, everyone thought they were infallible.
Right, like totally too big to fail.
Exactly. Now, imagine a long-term investor who was so confident in this blue-chip giant that they made it 45% of their entire retirement portfolio, planning to hold it for 20 years.
Because it's a sure thing.
Right. But what happens? Technology shifts. The industry gets disrupted by new innovations. The regulatory environment changes. And over the next 15 years, that massive company slowly bleeds out or even goes bankrupt.
And the investor's 20-year time horizon didn't save them.
No, it didn't, because they permanently impaired almost half of their total wealth. You cannot compound capital if you lose half of your base to a single point of failure. The Kelly math and deliberate position sizing are designed to protect your core capital base against those unforeseen structural shifts, whether you're holding for a week or a lifetime.
That is a brilliant way to frame it. Time does not heal an amputated portfolio.
Wow, yeah, that's a great way to say it.
So what does this all mean for the listener tracking their own accounts? Let's distill the key takeaways from all our sources today. Because overcoming these psychological traps requires a fundamental mindset shift. You have to move away from a one-and-done approach and start treating portfolio management as a dynamic living process.
The core takeaways are very clear. First, position sizing is the fundamental mechanism for balancing risk and reward. It is not an optional advanced tactic. It is the very core of risk management.
Got it.
Second, we have tools like the concepts behind the Kelly criterion that take the specific risks and returns of an opportunity and give you a mathematical baseline. These tools remove the emotion from the driver's seat.
Right. And third, as the CFA Institute reminded us, this discipline applies to everyone, from the rapid-fire trader to the decades-long retirement investor.
Which brings us to a critical directive from the SEC. The Securities and Exchange Commission mandates that professional money managers continuously monitor risk. Why? Because market conditions change, and the underlying math of your portfolio changes with them.
Makes sense.
Therefore, position sizing demands ongoing monitoring and continuous adjustment to ensure your portfolio stays aligned with your target risk tolerance.
So, how does a changing market actively break an initially perfect position size? If I use the math and I buy exactly 5% of my portfolio in a stock today, how does that get broken if I don't touch it?
It's usually broken by massive success.
Wait, success is the problem.
Yes. Let's say you allocate that perfect 5%. Over the next 3 years, the company executes flawlessly. The stock doubles, then it triples, then it goes up some more. Meanwhile, the rest of your diversified portfolio grows at a normal, steady 8% a year.
Okay.
Suddenly, you look at your account, and that single winning investment no longer represents 5% of your total capital. Because it grew so explosively, it might now make up 25% or 30% of your entire portfolio.
So it organically became a massive concentration risk, even though I never actively added another dollar to it.
Exactly. The changing market conditions actively broke your initially perfect position size. You are now heavily, disproportionately exposed to the risks of that single company.
Wow.
If they have one bad earnings report, or the CEO leaves and the stock drops 30%, your entire portfolio suffers a massive blow. That's why the SEC emphasizes ongoing monitoring. You have to act as your own fiduciary. You have to regularly review your portfolio and make adjustments.
Which means doing the absolute hardest thing in investing, trimming your winners.
It is incredibly painful psychologically. You have to sell a portion of that wildly successful investment to bring its position size back down from 30% to a more optimal risk-managed level.
Right.
It feels completely counterintuitive to sell something that is winning, but it is mathematically necessary to protect the overall ecosystem of the portfolio.
Going back to our kitchen analogy from earlier, it's kind of like checking the soup an hour after it's been simmering. A lot of the water boiled off, the flavor's concentrated, and suddenly that initially perfect amount of spice is now way too overpowering.
Yeah.
You have to dilute it or add more base ingredients to keep the dish balanced and edible.
That is precisely what it means to treat portfolio management as a dynamic, living process. You are constantly tasting and adjusting the recipe.
This has been incredibly eye-opening. We've moved from the vague, fuzzy idea of don't put all your eggs in one basket to the hard, calculated mechanics of actual risk management.
But before we wrap up today's deep dive, I want to leave you, the listener, with one final provocative thought to mull over.
Oh, I like a final thought. What is it?
We've spent this entire time talking about the math of position sizing, how tools help align your portfolio with your financial risk tolerance on a spreadsheet. But it is always worth considering how your emotional risk tolerance fluctuates during different stages of your life.
How so? Like mathematically versus emotionally?
Yeah. Exactly. A perfectly calculated 10% allocation to a volatile asset might make total mathematical sense on your spreadsheet. The formulas might prove it's the optimal move for long-term growth. But if the broader economy enters a highly volatile, terrifying phase, does that perfectly calculated 10% still let you sleep soundly at night?
Oh, that's a great point. Are you checking your phone at 3 in the morning?
Exactly. The math is essential for finding the ceiling of what you should risk. But at the end of the day, you are a human being, not an algorithm. You still have to live with the portfolio you've built. Sometimes optimizing for a good night's sleep is the most important calculation you can make.
That's all for this weekend's Deep Dive. Come back tomorrow for more investor education and weekdays for daily market coverage. Like, subscribe, and we'll see you next time on Tech Money Madness.